Yes, people, welcome back to FutureFunded. Today I'm going to be going through a key market structure element that has allowed me to pass my accounts with FutureFunded, get profitable, receive consistent payouts, all because of this simple element, and I'm about to show it to you. So let's jump into it. All right, let's get into this. This is one of the simplest forms of an entry model that I can look for, and it's all based upon a high time frame structure. It's got nothing really to do with lower time frame. Obviously, you still do enter on lower time frames like the 1 minute and the 5 minute to get your entry model, but the overall structure of this and the theme is purely based upon the 1 hour and the 4 hour. All right, so let's just focus on US 30. You can see here prices pumping to the downside. We've got low, lower high, lower low. All right, so now that we've got that and we can confirm that, we know that our range high is right here and our range low on the hourly is right here. Now, what I want you to focus on is look at what price does every single time it attempts to move down. So can you see how prices reacted? We've then had a failed high. And what I mean by a failed high is price failed to break the low. And I'd say immediately when it does do that, this high that attempts to take out the low now becomes nothing more than liquidity. It's just an area where retail traders, or there are loads of orders set up there where this move has attempted to push down. So what does that mean for anyone who's looking? Well, if we know that we're in the 1 hour bearish internal range, we know that there's a pretty good chance, considering this has now become liquidity and price is now reversed, we know there's a pretty good chance that price is going to come and take that out and potentially try again. And look at exactly what it does. It comes back up, sweeps that high, and it tries again. Fails. Now look at what it does again. It comes back up to the new high, which is now a failed high. Why is it a failed high? Because price failed to take out this low. And price comes straight back up and attempts it again. Okay, so you can see comes back up, attempts again to move down, fails. All right, now why is this important? This is important because you can just get opportunities within this. You can get selling opportunities within this, because the reality is, if you go from, let's say here, you see that this is a failed high. What I mean by that is that price has failed to take out this low. You can now very simply just wait for price to come all the way back up. You know that there's a pretty good chance that price is pumping up anyway, that it's probably going to come and take this area out, because this is nothing more now than just liquidity basically. And look at exactly what it does. It does the exact same thing here. So it comes up, taps into this high, takes out all the orders, and then we get a move down. And even here, it fails to break that low. All right, so even here, this is still a failed high. What does price do? It comes all the way back up and it starts to process again. Comes just enough back up to actually take out the previous high, and then starts playing around and carries on its market trajectory. Okay, but what this is, well, I should say what this means for me is all I need to simply do is wait for price to come up and take out these areas. And bear in mind, guys, I'm on a 1 hour time frame. I was to scale down into a 5 minute or a 1 minute time frame, the entries that I can catch here on a 5 minute and a 1 minute, here, and especially here, is huge. All right, it is. You're on a 1 minute and a 5 minute. Yes, you know that the overall theme of this is to take out the liquidity. So let's say that I'm looking for entries in this area. I know that all I have to do is wait for this to get taken out. As soon as I see my entry model on a 1 minute or a 5 minute, I can then look to go short. And where am I targeting? I am very simply targeting liquidity. Well, where is the liquidity? Well, there's liquidity there. And there's also more liquidity right here. And then I can make a decision, which one do I want to go for, this liquidity or this liquidity? All right, and obviously you can base it purely upon what is comfortable for you, what you think is going to work and so forth, because yes, okay, 1 to 6 sounds tempting, but the reality is if you don't think it's going to get there, you don't think it's going to get there. You need to base it on where you believe price will actually go to before we get a reaction that might go against us. Okay, now again, guys, this is obviously quite a wide stop, right? Remember, if you're entering on a 5 minute or a 1 minute, you've probably got a much tighter of a stop loss. All right, and this is what I'm saying, you can catch a 1 to 5, a 1 to 6, and this, that, and the other, and you're simply doing it by just waiting for liquidity to get grabbed You understand that the market structure is bearish. You understand that the 1 hour time frame is in a bearish internal range. And all you are doing is following price. You're just following the failed lows. You're waiting and seeing whether price has taken out the low. If it hasn't, you're just waiting for price to come back up, sweep the high, and then you can enter. And then if it does the same thing again, like it does here, and fails to break down and take out the actual 1 hour internal low, then guess what? If price is starting to move back up, all you need to do is simply wait for price to come in, take out this high, because this is nothing more than just liquidity now, and then you can start to look to go again, essentially. All right. And you can carry on doing that up until the point where price actually does break the low. If it breaks the low, the market structure is shifted and this is no longer viable. All right. So I hope that makes sense, guys. This is one of the very things that I've consistently used over the years. It's one of the most simple methodologies to use. And to be completely honest with you, the simpler you make the markets, the better. The more you overcomplicate it, the more things you have to wait for, the more likely you're not going to get in, and the more likely you're just going to end up missing trades that actually are your plan, but you're waiting for 50 different things, so you're hesitating. Whereas the reality is, this is so simple, so basic, but yet so effective. All right, and I hope that helps, guys, and I'll see you in the next video. So there you have it. See, it's one of the most simplest market structure elements, but it's one of the elements that has allowed me to be consistent over time and truly understand market structure. So guys, if you found that useful, go to FutureFunded, get your challenge, check out the educational stuff on both futures and FX and see for yourself, and I'll see you inside.